Today's webinar is just about that one area of investment management. And that's what we're going to focus in on today. So I'm going to start off by sharing my screen, and I want to show you one of our indicators. Okay, now with our approach to investment management is we designed various models and indicators to help us make decisions for clients, to understand the markets, understand the market tendencies, and to be proactive with our ongoing decision making. And this is what we call our AWM valuation indicator. And I won't get into all the details in terms of how it's recorded. However, what I want to point out is you can see that it's dropped quite a bit in the last year or so, but let's take that out. Let's go back to this high, which was at this time last year. At this time last year, this valuation indicator was at its all-time high. So what that simply means to us is that stocks, or in this case, specifically the S&P 500, not all stocks, but specifically the S&P 500, was priced at its highest valuation ever, going all the way back to, as you can see on the chart here, 1960. So if you're buying stocks, the end of 2021, early 2022, you were paying the highest valuations in the last 80 years, 60 years, I'm sorry. So what that simply means is not necessarily that we're going to see a market drop, but that did develop last year, but it means the market is susceptible to a downturn. There's a lot of air underneath stock prices. Of course, it takes a catalyst to start that momentum turning in the other direction, which we did get from other models that we'll look at as we go through this webinar. However, the market was priced for a drop at some point. Now, the other thing that we'll point out is the previous high was here in the year 2000. So that was the last high point for stock prices. And the other thing that shows on this chart is not just what the valuation of the market is, but what happened in the S&P in the next 10 years. And that's the shading in the background, right? So when we had the high in 2000, the next 10 years shows right here. It was actually a negative return for the next 10 years in the S&P 500. And that's how we use this indicator. High valuations mean that forward returns are likely to be low. Low valuations, as we saw once that completely worked its way out and the market got down to a much lower valuation, it took about 10 years for that to happen. But if we go back to 2009, that was really a low point for stock values, meaning that now you're buying good value, right, in 2009, and hence the forward 10-year returns were very high. So as valuations climbed higher and higher, we expect forward 10-year returns to be lower and lower. And at some point, when that peak hits and the pendulum starts to swing in the other direction, then we have a cycle of market values declining. And those cycles tend to be pretty long in nature, right? This took about 10 years to go from high valuation in 2000, the low valuation in, say, 09 or 2010. The previous cycle took even longer. We're going back to, obviously the previous era in the late 1960s when the high valuation was hit. You could see back then the forward 10-year returns were very low for the S&P. And then as it took several years for valuations to get down to a low level, but throughout all of this, the 1970s and early 1980s, stocks were priced for at very low levels, meaning forward opportunity is good. And you could see then there was a lot of great opportunity over the following 10 years. So our view today is that since the pendulum has started to swing, it's likely not to just kind of stop mid-cycle. Typically, when these pendulums start to swing, they go full cycle. Now, it doesn't mean that it's a straight shot from high to low. It means that generally speaking, over many years, you're likely to see stock values get better. And that could take a while. However, there are going to be pauses along the way. And, we're probably in one of those pauses right now. In fact, this shows that 3 consecutive quarters, stock prices were declining and valuations were improving. And that's pretty rare to see 3 quarters in a row of negative stock prices. But we did see that last year, and now we're getting a little bit of relief. Sometimes that relief could be just short-lived, as you could see here with some of these little up moves. Excuse me. And other times they could be a little bit longer. Pardon me. They could be a little bit longer in duration. For example, once we had a big down move in 2001, 02, starting in 03, there was an opportunity in the middle of that 10-year decline in stock valuations. And this was significant because this was about a 4 to 5 year opportunity where stock prices were once again beginning to rise. Now, during that, you'll find, better opportunities in certain asset classes over others. It might be certain industry groups. It might be other countries where there's better opportunity. But nonetheless, at some point, we'll experience one of these types of opportunities, even if we're in a longer period of declining values of stock prices in the US. And right now, that's what we believe is taking place, is that the pendulum has swung. We've put in the high for that cycle, and that's likely not a short-term effect. It's likely something that will take, many years to completely play out before we get to a point where we could say the market's at a great time to buy and expect strong returns over the following 8, 10, 12-year period. So that, I think, is just an important starting point in terms of where we are in the market cycle. Now, again, I want to place very strong emphasis that this is the S&P 500 only. When we look at other asset classes, small cap stocks or value stocks, we don't see the same situation where we're at extremely high valuations. It just took place in the S&P, the US mega cap companies, which ran up significantly in value through that 10 or so year period from 09 or 2010 up to 2020, 21. That was when the high was put in. So today, there are other asset classes that have better value and better long-term opportunities. And this might be a good time to, just transition into what some of those asset classes are. Yeah. So this is how we compare big asset classes against each other, and we call them asset class indicators. For those of you who took classes from me perhaps years ago, we covered this. You may not remember it because it's been so long, but we did show you these are some of our early charts and indicators that we developed to help us identify opportunities and cycles and change of cycles developing. And what we're looking at here is US growth stocks compared to US value stocks. Okay. And very simply, the way you look at this chart is when the chart is rising, like it was through this period, it means growth stocks are outperforming value stocks. And when the chart's declining, like it was during this period back here, it means the opposite. Value stocks are outperforming growth stocks. Now, this is a relative indicator, so it could mean if the market's dropping, that value stocks aren't dropping as much during that time. Or if the market's rising, that value stocks are rising more than growth stocks during this type of cycle, and vice versa. Growth stocks are either rising more during an up market or declining less during a down market during this period. Well, what we could see on this chart is that we believe a cycle change has taken place. In fact, it's been confirmed for a couple of years now. If we go back to this time in, say, 2021, we started to see a peak in this indicator and that potential rollover took place right in here, and that's continued to follow through. So for the last 2 years, value stocks have been much better investments than growth stocks. For most of that time, what it's meant is that value stocks haven't dropped as much as growth stocks. Last year, bear market, stocks dropped. Far and away, growth stocks dropped significantly more than value stocks. But we can see that these trends are very long in nature. We're going all the way back here. You can see the timeline to 1984. And during this period, from 1984 up to 2000, for the most part, it was a growth stock market. That's where your best opportunities were. Starting in 2000, all the way down here to the low in 06, so that 6-year period, value stocks outperformed. And then that cycle turned. And really, as we came out of that 2008 bear market, right in here in early 2009, that confirms that growth stocks are back in the lead. And it pretty much was just a growth stock market going all the way through from 2009 up to the highs of 2020, 2020, 2021, even early 2022. But that's unwinding now, right? So the reason that I point this out is very simply what you find today is because we had that really long period, right? Super long period of growth stocks, which are the popular companies that were the winners. Everybody believes that that will continue into the future. History shows us that that's not likely to be the case, right? So the winners of the previous bull market, whenever this bear market is over and we have a new bull market in place, is not likely to be the last bull market winners, right? And this is a great theme by decade chart that I like to show that just shows every decade experiences a major winning asset class. So if we go back, let's say, for those of you who have been around for at least a little bit of time, say to the 1970s or 80s, you could see in the 70s, emerging markets and commodities were the big winning asset class during that time. The US stock market didn't do well in the 1970s. It was a high inflationary period, maybe similar to what we're in today. Stocks struggled, went through a decade plus of no gains. We looked at that a little bit on that previous market valuation chart. But these asset classes boomed during that time. But what happens is once the asset class goes through that multi-year boom, it also experiences a bust. And typically for the next 10 or 20 years, that asset class is a poor investment. We saw that with Japanese stocks in the 1980s. In fact, peaked right the last day of the 1980s, December 31st of 1989, has never gotten back. The Nikkei stock index has never gotten back to where it was way back in 1989. Then we saw the tech stock boom in the 1990s, right? And that, of course, bust in 2000. And tech stocks went through a decade of poor performance following that bust. But what happened? We went back to the emerging market and commodities boom. And while US stocks, and particularly tech stocks, were very poor investments during that first decade of this century, emerging markets and commodity-related assets were very strong investments. But once that boom turned into a bust, in the last 10 years, they've been poor investments. And the money rotated to what we call American mega cap stocks, right? I'm not going to mention any specific names, but you know the ones, right? These are the popular companies, the ones you think about that run the S&P 500. Those are the ones that really are important to the market indices. They've gone through their boom. They're going through a bust now. And all I'll simply say in that regard is I see a lot of investors still holding those stocks, waiting for them to come back and expecting them to be strong investments again. And I think those investors are likely to be disappointed. I don't think you're going to see those stocks be the big winners of the next bull market, whenever it starts developing. We may be in the early stages of that, or it may, we may have a lot more downside to go in the markets overall before we get there. But whenever we get to that next opportunity, you're not likely to see the previous winners, become the leaders again. So money's going to rotate. There's going to be new asset classes, new opportunities developing. And that's why when we look at this indicator, value stocks are much different animals than growth stocks. And at a minimum, we think that this is still, not in the very early stages of that cycle unwinding, but maybe in the middle part of that cycle unwinding, and probably a lot more room to go to the downside, which means better performance in value stocks than growth stocks. So that's one area to pay attention to, I believe, over the next, say, 2 to 5 years. The second area that I want to point out, I'm going to come back here and I want to show you this chart, which to me is an eye-opener in the sense that it shows just how much U.S. stocks have outperformed virtually every other stock market in the world, bar none. So we're going back here to 2008. So this is through a 14-year period, right? 2008 through the end of last year, 2022. And during that period, what we see is, of course, everything was dropping in 08. That was the financial crisis and, big drop. They both dropped about the same amount during that time. We're talking about a 50+% decline in value in these major stock indices. Of course, that's important that you avoid those types of declines. You don't want to just invest in one area over another because it potentially is stronger. You still need risk management in place. And I'll show you, that's a big part of our efforts of wealth preservation. And when we go into the next part of today's webinar, we'll be showing you some of the tools we use to help avoid going through major declines in value when they occur. But off of that bottom in 2008, you could see everything started to move up for a while. But right in here, say 2011, 2012, everything just separated. And the U.S. stock market just boomed. Of course, the U.S. stock market is dominated by those mega cap companies that we talked about, just a minute ago. But you could see that peak that came in place right at the beginning of last year, 2022, and some unwinding of that has certainly occurred. But look at what the world ex-US stock market has done in that 14 to 15-year period. There's been no growth in the world stock market by taking the US out. So think about that. We're talking about a decade plus of no growth. You could buy these stocks at the same place they were priced in some cases 15, 20 years ago. And we'll go into some specifics in a minute. Just think about if you were able to buy the S&P 500 at the same place it was 15 years ago, where that would put the S&P 500 and what opportunities would be ahead over the following 10 or 15 years. And that's the way we see this market set up today from a global perspective. Now, that doesn't mean right today the opportunity is here. It may be. A lot of that depends on the economic cycle. A lot of that depends on the market cycle. If we've hit a bottom of the bear market, we think there's a good chance that you're going to see some lengthy period. Maybe it's 5, maybe it's 10, maybe it's longer number of years of outperformance of foreign markets over the U.S. large cap market. Right. So when we look at our asset class indicators, we looked at growth versus value. And what I'd like to shift to now is looking at a different type of indicator. This compares U.S. large cap stocks to the developed international markets. Now, how do you define developed international markets? Well, we don't do it. We rely on the market index companies to do that. But essentially, these are the foreign markets that are in developed economic countries, right? Western Europe, Japan, Australia, the foreign markets that are in the developed countries. And, we're seeing a bit of a change taking place here. But before I get to that, let's go back in history. And, once again, these asset class indicators are extremely long forward looking in nature, right? They're not going to tell you what's going to happen in the market in the next week or month or even quarter. But what we're trying to get at is where are the better opportunities over lengthy periods, 3, 5, 7 years, maybe even longer. And we see that these leadership changes rotate. So if we go back to the second half of the 1990s, right? You could see as this chart was rising, that's a clear indication that the US stock market was much stronger investment opportunity than the foreign markets in the second half of the 90s. Then you could see it, kind of that top took place, and then the transition down in this chart is now telling you that foreign markets are a much better investment opportunity. And that continued not just for a year or two while the stock market was dropping in 2000 and 01 during the tech bubble, but it continued in the recovery period in 03, 04, 05, 06, right? Foreign markets continued to lead the US market. And then the cycle changed. 2008 was a very volatile year, but you could see it started to build to the upside. And then particularly as we got into 2011, 12 here, you could see how this chart just took off. And that was the sign that the US market was the big outperformer and had far and away the better investment opportunities, right? So if we just relate that to the chart we just looked at, you could see it was right in here, 2011, 12. That was the time to really focus on the US market and reduce or even eliminate allocations to the foreign markets. Now let's take that to current position. We saw a peak in this indicator about 6 months ago, last August. Starting late last year, it started to drop. November, December, that's what these numbers on here represent. The months, January of this year, we've seen the first signal that foreign markets are beginning to outperform the US market. And that goes all the way back to 2009, 2010. So this is the first sign in more than a decade that you're starting to see the foreign markets outperform. Remember, these are relative charts. Outperformance means if the market drops, foreign stocks might drop less. If the global markets rise, foreign stocks probably will rise more than US large cap stocks. So I think that's the second takeaway of today. When we look at last bull markets winners, growth stocks far and away led the way. That's where virtually all the money was made, right? In those household names, Apple, Microsoft, Amazon, Google, Tesla, Nvidia, right? Those were the big winners. They're not likely to come back to be market leaders again for a long time. So if you're waiting for that to happen, it may pay for you to start to look for other opportunities to regain some of that lost capital if you did ride the market down in the 2022 bear market. Secondarily, moving forward, even if the US stock market struggles, which once again, that's what this indicator is telling us. The US stock market, not all sectors, not all industry groups, certainly not all stocks, but the stock market as a whole, particularly S&P 500, it's no longer at its all-time high valuation. It's at more moderate valuation after the decline that we've seen. But it's by no means at a low valuation and these setups that we saw for a booming decade or longer in the past. So whereas the US stock market went through a lost decade starting in 2000 and took many years to recover, we went through a lost decade starting in the 1970s, and it took many years to recover. It's very possible that we've gone through that. We're beginning to go through a lost decade for the US market, but opportunities will emerge in other areas. It's just important that you keep your options open, you know how to find them, or you're getting information that is able to point you in that direction. And you're not just expecting, what was the winner in 2020 to be a winner again moving forward. And I really want to dive in further to the foreign markets and just point out, just how strong the setup could potentially be. Now, just because there's better values there and they're outperforming doesn't mean that those markets are going to boom. A lot of it's going to depend on the global economy. If we go into a global recession, there's a leg down in markets across the world. It's just that the US stock market is priced higher. It's going to drop more than likely. If we avoid a global recession, then we may be on a recovery path. And if that's the case, then there's better opportunities in the foreign markets. Now, this is one of our proprietary indicators. We call it a long-term momentum chart, and this is for that developed international asset class. And what we could see here is where we are today, or I'm going back to the end of last year. If we look at where this index is today, it's basically at the same level it was sometime in 2006. So you're able to buy stocks in these, and these are the big companies of these foreign markets and the developed foreign markets, right? You're not buying China, right? You're not buying emerging economies. You're buying big established economies. You're able to buy those stocks at the same prices they were at going back to 2006. So we're at a 16, 17 year period where there's been no movement in these stocks. There's been no progress, right? So that these stocks have already experienced the lost decade plus. The US may just be beginning that lost decade, but these stocks already have. Right. This is another interesting chart, which kind of combines the two indicators that we've spoken about: growth versus value. We see value stocks outperforming growth, and the the foreign markets versus the US market. We're beginning to see the very early stages of foreign market leadership. Well, this combines it. These are foreign value stocks. And once again, what you see is where they are today. And what I'd even like to do is go back just a few months ago to September of last year and that low, and look at where those stocks were trading, were basically the same place that they were trading at the turn of the century. So you have a 22-year period here where foreign value stocks are priced at the same level they were 22 years ago. To me, that's a great setup for potentially an asset class that could experience a strong move. Now, what does a strong move look like? Well, look at this move right here. Right now, we talked about the lost decade starting here in 2000. US stocks performed very poorly. From 2000 to that low in 2009, US stocks were by far the very poor performers. Well, in the middle of that, look at this opportunity in foreign value stocks. You're looking at an index going from, say, 1,500, almost tripling in a 4 or 5 year period during that time. So that type of opportunity could come together again. In fact, probably will at some point, and it will pay to pay attention to when that's developing. This is one of the indicators that we'll use to help us identify that opportunity. You could see the transition from red to green here kicks off that strong multi-year movement, a flip up in our momentum indicator, right? So we're watching for a similar type of move now. A little early to say that that's definitely in play, but certainly a potential that we're monitoring. So let's get away from the foreign markets for a minute. Let's get away from value. Those are big asset classes. It will more than likely pay to have some focus and larger allocations in these areas over the next 5, 10, or even longer period of time. But let's look at a few other types of opportunities that we see developing. Right. So first one I want to pull up here is these are energy stocks. And in particular, it's not the Exxons, it's not the big name energy companies that you think about. These are the energy equipment and service companies, right? The companies that actually provide equipment, do the drilling, and service the big energy exploration and production companies. And once again, when we look at great value and great opportunity, what we see is the current position of this sector is basically the same place it was going back to 2000, even into the 1990s. So you don't have that high valuation. You don't have those lofty prices like we do in the US mega cap companies. We have very low prices, very low valuation. And for a long period, these stocks were considered not important anymore, right? The whole ESG movement and, with the move to clean energy, well, that's changed very quickly. And suddenly the world realizes, yes, we want to move to clean energy, but we still need oil and gas production. And these are the companies that make that happen to a large extent. Now, this has actually been moving for a couple of years, as you could see, coming up off of its low. But likely, if we're in one of these longer stretches, there's a lot more room to go. And you could see the previous highs, whether we get back there or not, the current level that we're trading at could have plenty of large percentage gains to the upside opportunity. So even if the US stock market as a whole or the large cap market struggles, this is an area that could be much different in terms of how, the directional movement and the opportunity over the next several years. Let's take a look at precious metals. These are precious metal commodities, right? Not the stocks, but the commodities. So this obviously includes gold and silver, but platinum and, all the precious metals. And again, very long-term look at here in nature. You could see how these booms develop. Previous to that, there was the bust, right, for many years. After that high, we went through a pretty good bust. And now you're starting to see potentially some upward movement. Again, this is a much different type of asset class. If stock market values continue to decline, or stock struggle, generally speaking, gold and silver and other types of precious metals don't necessarily have to follow suit. Right? Let's look at the precious metal mining companies. So these are the precious metal mining stocks, not the commodities, but the stocks. And once again, what you're looking at is current levels of these stocks are basically trading at the same place they were in the mid-1990s. So you're not buying ultra high valuations like we are in many US stocks. You're buying extremely low valuations. Of course, the precious metals are going to really dictate, the commodities will dictate the trend here, but these are stocks that could potentially have great opportunities and be completely uncorrelated or very uncorrelated to the US stock market and the major market indices, the S&P 500, et cetera. So now I want to switch the discussion away from current market conditions and more to just overall approach to investment management. And, when we look at investment management, and philosophies, of course, from one investor to another or one investment firm to another. They're going to vary widely, from passive strategies to active strategies. Some use fundamental analysis, others use more quantitative type of analysis. Some advisors will manage your portfolio in-house, while others will outsource those decisions to third-party managers. So what's the best investment approach for you? It really has to resonate with you, right? Like what resonates with you? In our view, we think that wealth management should help you achieve two primary objectives: security and prosperity. So your investment management approach should dually seek to accomplish both of those objectives, not one or the other. Right now, some strategies or philosophies aim to provide security, but fall short in helping you continue to prosper. Others focus on growing your wealth, but they're not adequate at, or don't even attempt to, in some cases, secure your wealth during market and economic downturns. So the investment approach that your advisors or you use, if you self-manage your portfolio, obviously has to resonate with you philosophically. We define our investment approach as proactive. The families that we work for worked hard to build their wealth. They want their wealth managers to work just as hard in continuing to accumulate more while preserving what they have. So we designed our strategies and decisions. They're based on and backed by a proprietary research database and custom software that we built. Over the years, we've built a substantial knowledge base by conducting more than 6,000 tests and research studies, all designed to help us understand market tendencies so we can make intelligent, proactive decisions for our client base. The result is our methodology that we call PAS, or Proactive Asset Allocation Strategy. So what I'll do is go through some of the tools and systems that we designed to help us make those proactive decisions. We already looked at one, right? Here's our market valuation model. This helps us understand, is the market priced at a good position to have long-term opportunity? Or is it priced at a high position, meaning that we should expect some bear markets to develop in the coming decade, right? We should expect to have to be more tactical with our investment decisions, to look for these other types of opportunities like we covered just in the early part of the webinar. So that helps us with an overall approach to our investment decisions. The second model that we developed is an economic model. This is a forward-looking economic model, uses various monthly leading economic indices or indicators, I should say, and develops into one comprehensive index. And what we see today is that this economic model is pointing down. The big move is below the zero line. That is a warning of a recession. You could see in times past, when we get the warning of recession, the gray bars are when the recession's actually developed, according to the government. Problem is, you can't wait for the government to tell you that, because, for example, in 2008, they didn't tell us for a year after the recession started that it started. And by then, you're already down near the low of the market and near the low of the economy, the economic cycle. So we need something forward-looking, and this is our answer to it. It doesn't speak often, but when it does, we want to pay attention. So right now, this is telling us that likely we will experience a recession. This is very forward-looking, so we don't know when it's going to start or how severe it's going to be at this point, but more than likely, we're going to have a recession, maybe this year, maybe next year. And why is that important? Well, very simply, market drops coupled with a recession are much more severe than market drops without a recession. So this shows a scatter chart of every 10% correction in the S&P 500 going all the way back to 1965. The black diamonds are each iteration of that 10% drop when there was not a recession. The red diamonds are each iteration when there was a recession. And you could see that the average drop without a recession is 15%. The average drop with a recession is more than twice as deep, 36%. So we expect bigger drops in the S&P when it's coupled with a recession. Again, this is an S&P 500 based look, not other types of asset classes. The other takeaway is the number of days to go from the high to the low is much greater when we have a drop coupled with a recession, right? So here you could see 300 or so business days. That's, roughly a year and a half, let's say, in nature for recession coupled bear markets versus just about 100 business days or just a handful of months for corrections that are without a recession, right? So when the market starts to drop the way that it did last year, when we get those recession warnings, we want to pay attention and expect it not to be short, probably something deeper and longer term in nature. The other model that we developed is our market model, right? And this is something that has been, in existence for, quite some time. We have our market model here that shows our indicators, and without getting into specific details behind the entire model, I'd like to show you a few of the indicators that are behind the signals developed by the model. So this model is probably the one that it is definitely the one that we focus most attention on. It's the one that speaks most often, right? Recessions happen few and far between, but when that model speaks, it speaks loudly and we pay attention. The market valuation only comes into play at certain times over many years. This is one of those times that we think it's important to pay attention to market valuation. But the market model that we use is really designed to help us identify the market cycles. Are we in a probable bull market? Are we in a probable bear market? Understand the inflection points or turning points that take place in the market. And we have a number of proprietary indicators that we develop to help us understand these market tendencies. And I'd like to show you briefly a couple of them. One is on the screen here. It's called our cash comparison chart. Very simply, the way we read this chart is when the trend is up, like through here, it tells us that stocks are performing better than returns you're getting holding cash. So it pays to take the risk to own stocks. When the trend is down, like through here, it tells us that cash returns are better than stocks. So why would we want to take the risk of owning stocks when we could take no risk and likely get a better return? The key points are when we get the potential turn in the market cycle. And I'm going to actually zone in on the two important times in, say, the last 20 plus years to really pay attention to market cycles. And the first is here in 2000, right? You could see the late 1990s was a great time to be in stocks for the most part, but that transition occurred in 2000. And then we had a lengthy period of time in which it didn't pay to be in stocks. These are sell signals in this indicator and feeds into potentially sell signals in the model. The model doesn't use one indicator, it uses several of them. And this is one of the key indicators that helps determine the market cycle. Are we in a bullish cycle or bearish cycle? You can see the turn here in 2003 back to the upside, which helps us identify that opportunity. But then as we hit the next peak, you could see how that cycle changed again. And we had the second bear market in that 10-year period in 2007, 2008. And that again feeds into a sell signal for the model overall. and we came down to the bottom, and the cycle turns back to the upside, right? So if we look at current conditions now, which is up here, we could definitely see some downward movement that has taken place. Is it a major turn in the market cycle? Still a little difficult to say with certainty, but when we're coming off of those high valuations, it's more likely that it is a major turn. I think a lot of will determine of if the economy does move into a recession. With our recession indicators pointing down, we give that a higher probability than not having a recession. Therefore, we think that there's a better chance than not that the peak we saw late 2021, early 2022 was a big peak, and we're in, say, the middle of what's probably a lengthier bear market. Let's take a look at this indicator, which shows equity market declines and recovery periods going all the way back to 1950, right? So we're looking at 72 into 73 years of market history. You could see in the last 20 years, there are 2 times very important to focus on wealth preservation. Here in 2000, here again as the market was peaking in 07 into 08. Those were the clear indications here from our cash comparison chart that the market cycle was turning. That's why we use these types of indicators. The other thing I'd like to point out on this chart over that 72 plus year period, the market is declining or recovering from a decline 54% of the time. It's only building new wealth 46% of the time. So we broke the chart down to green areas when you're actually making new wealth, red areas when you're losing wealth if you buy and hold the S&P 500, blue areas where you're recovering the previous lost wealth, right? And then the green areas again. So you're only actually in new wealth accumulation mode if you buy and hold and ride out every market downturn 46% of the time. More than half of the time, you're either losing value or you're recovering value that you lost. So our main overriding investment philosophy rejects or challenges common wisdom that says you should ride out every market downturn because markets always recover. That may be true, that markets always recover, but is that going to happen on your, in your investment horizon with your goals, your circumstances, your objectives? Maybe, maybe not. Second, even if that's true, these were 250% declines in value, which took 100% recoveries to get your money back. And it took 13 years to recover that 2000 high and start to build new wealth in 2013. Nobody wants to go through 13 years of not making any money or losing money and recovering it moving forward, right? So it's not a comfortable approach. It's, it's very, very uneasy. So we designed our indicators like the cash comparison charts to help us avoid writing down these types of markets only to then take several years to recover, right? If we could cut this short, we could have those green parts building new wealth much more often and have the blue recovery periods be much shorter. That's our goal, is to preserve wealth on the downside, but provide prosperity so you can enjoy your life when the risk is low and opportunities are there to build wealth with a high degree of probability that we could be successful doing so. We're not after trying to avoid every little minor decline, right? In our view, 10, 15, 5, 10, 15% declines are sometimes hard to pick up. Those could just be random, little drops here in an ongoing bull market. But what we're after is avoiding the big ones. Once you start getting into 30, 40, 50% drops, well, now it takes a 40, 67, 100% increase to make back lost wealth. Our clients' number one concern is preserving their wealth. Yes, they want to grow it too. They have goals and objectives and aspirations to achieve with their wealth. They want to accumulate more wealth, but first and foremost, they don't want to lose the wealth that they've built over their working years and working lives. Another one of our proprietary indicators is our long-term momentum indicator. And this one is very different, but basically speaks to the same approach in the sense that we're looking at identifying major market cycles, particularly the down cycles, because that's when wealth preservation becomes important. So this uses a number of different calculations of momentum and moving averages, and then combines all those calculations into either they're all positive, in which we have the green shading on the chart, they're all negative, we have the red shading on the chart, or there may be some mixed signals. We have the white shading, and that's a neutral status in this indicator. Right. So when we look at, again, the two important times in the last 20, 25 years to preserve wealth is right here, 2000, right here, 2008. And you could see how this indicator, not at the high because it's a momentum indicator, but early enough in that decline turns red. When it turns red, our caution system goes way up. And we know that there's a higher potential for a bigger market drop. Why? Because the market never really drops big time when it's green. If you look at all these times, it never really drops big time when it's green. So only when it's red does it go through these major declines. Not every time it turns red do we have a major bear market. Sometimes they're more minor and mild and quicker recoveries. Still bear markets, but not major ones. But when the big bear markets hit, the ones where you really want to sidestep them and focus on preserving your wealth as opposed to building wealth, this indicator gives us the signals early on. We use it in combination with our cash comparison charts. We don't use one over the other. They're both equally important, as well as some other indicators. But these are the proprietary tools and systems that we built to know when to change approach to preserving wealth and not try to grow wealth during those periods. And again, 2000, 2008, those are the big times to preserve the wealth. And both of these indicators spoke pretty loudly there. Now, here you could see another pretty loud signal occurred right at the beginning of last year. You could see how it was green coming off of the COVID low, and then it turned white for a while as the momentum started to fade, and we saw the neutral status, and then red, negative, very early 2022. And I'm getting my bear markets mixed up, not 2008, 2022. And you could see how, this is a little dated, goes back to not September 30th. So there's been a bit of a bounce since then, but nonetheless, that was a clear signal. Coupled with this clear signal is one of the reasons why we changed our investment approach materially last year to focus on wealth preservation and avoid the downturn in the market. And that paid off substantially for our client group in 2022. So that's going to wrap up the presentation specifically. I'm happy to answer any questions. As I mentioned at the start of the webinar, we're going to offer everybody who attends a second opinion on your wealth management plans. We're finding a lot of families, affluent families, are interested in knowing if their current strategies, whether it's an investment strategy or tax planning or wealth management, non-investment planning, is really on track in the current economic and political environment that we're in. So we're happy to offer you a second opinion where we'll sit down with you. We'll look at your current plans. First we'll discuss what's important to you to understand where you are now, where you want to go. And then we'll look at your current plans to get there. We'll evaluate if they're adequate. If they are, we'll tell you that we think you're in good shape, your advisors are taking good care of you, or you are are doing a great job on your own to stay the course. If we think there's room for improvement, we'll evaluate if we're the right advisory firm to help you. We can't work with everybody. We limit our client group to select families where we think there's a real good fit and we can make a significant impact in their lives if we work together. If we don't think that we're the best advisors, we'll point you in the right direction. We'll provide you the resources to make improvements to your plans. If we do believe that there's a good fit, then we could discuss inviting you into our family of clients and working together in achieving all that's important to you. So if you decide to have a second opinion, it'll start with a phone call, very, non-committal, informal. We'll just have a discussion, talk about your situation, see if it makes sense to move to the next step, which is a discovery meeting. And that's when we'll get into the details about what you're trying to accomplish, so we have a good understanding of it and we could evaluate from there. Thanks everybody for attending. Hope that you found some valuable information.